The numbers just came in from Beijing, and they're telling a story that nobody saw coming. While American policymakers were busy threatening 100% tariffs and European leaders debated their next move on Chinese imports, something extraordinary was happening in the global trading system. China's exports to the United States plummeted 30% in December 2025, the steepest drop in years. Meanwhile, shipments to Africa surged 22%, trade with ASEAN jumped 11%, and even exports to Europe climbed 12%. The world as second largest economy was quietly executing what might be the most ambitious economic pivot in modern history. And it's all happening under the banner of 5 letters that are reshaping everything we thought we knew about international commerce: BRICS. But here's the trillion-dollar question that is keeping economists awake at night and causing currency traders to refresh their screens every few minutes. Actually replace the massive consumer markets of America and Europe that have fueled China's meteoric rise for the past 4 decades? Or is Beijing making a calculated bet that will fundamentally backfire?
Before we go further, I need to be clear about something. What you're seeing here is only the public layer of this story. For channel members, I break down what happens next, the timelines decision makers are actually working with, and the scenarios that won't be discussed openly. If you want access to that deeper analysis, you can join the channel by clicking the Join button below.
Right now, as you're listening to this, Chinese factories are pumping out products at a record pace. In the first 11 months of 2025 alone, China's total foreign trade reached $5.83 trillion, with exports climbing 6.2% to $3.46 trillion. These aren't just numbers on a spreadsheet. Every single dollar represents real products, real ships crossing oceans, real containers being loaded and unloaded at ports from Shanghai to Rotterdam to Lagos. And the destination of those containers is changing in ways that would have seemed impossible just 5 years ago. Let's rewind for a moment and understand what we're actually talking about here. BRICS started as an acronym dreamed up by a Goldman Sachs economist back in 2001. Brazil, Russia, India, China, and later South Africa. It was originally just a catchy way to group emerging economies that seemed destined for growth. But something unexpected happened. These countries actually started taking it seriously. They held their first official meeting in 2009, right after the global financial crisis had shattered faith in Western financial institutions. And in 2025, BRICS isn't just a catchy acronym anymore. It's expanded to include Egypt, Ethiopia, Iran, Indonesia, and the United Arab Emirates. Together, these nations now account for over 40% of the world's population and more than 35% of global GDP when measured by purchasing power parity. Think about that for a second. 40% of humanity. That's 3.2 billion potential consumers, workers, entrepreneurs, and innovators, all potentially trading with each other outside the traditional Western-dominated system. China, sitting at the center of this block with an economy that dwarfs most others in the group, accounts for 60% of BRICS' total economic output. This is China's show, with supporting actors who have their own reasons for wanting alternatives to American and European markets. Now here's where things get really interesting. The official BRICS Trade Index, compiled by China's General Administration of Customs, climbed to 301.51 points in 2024, up from a baseline of 100 points in 2009. Trade scale grew to 283 points, innovation hit 342 points, and the trade potential indicator skyrocketed to 387 points. In plain English, trade between China and other BRICS members has tripled in volume, and the potential for future growth is off the charts. But raw numbers only tell part of the story. What matters is whether these growing trade relationships can actually compensate for what China stands to lose in Western markets. And to understand that, we need to look at what's happening on the ground right now. Between January and November 2025, China's trade with ASEAN, an increase of 8.5%. Trade with countries participating in the Belt and Road Initiative hit $3.02 trillion, up 6%. Meanwhile, trade with the European Union grew by nearly 6% to $850 billion for the full year, while trade with the United States collapsed by nearly 16% to just over $600 billion. Here's the thing that makes the situation so complex. It's being forced into a corner by American tariffs and European anti-dumping measures, and it's desperately trying to build alternative markets before the Western door slams completely shut. The problem is that alternative markets come with their own set of challenges that don't show up in the trade statistics. Let's talk about what China actually sells and where those products go. Electrical machinery, telecommunications equipment, computers, industrial machinery, these are the backbone of Chinese exports, accounting for over 60% of everything the country ships overseas. And here's the brutal truth that Chinese economic planners are grappling with right now. The European Union and United States aren't just any markets, they're premium markets. They're where Chinese companies can charge higher prices, where intellectual property protections actually mean something, and where payment systems work reliably. Each accounting for more than 15% of China's total exports, these two destinations represent not just volume, but value. When China ships smartphones to Germany or electric vehicle components to California, those transactions happen in stable currencies, through established banking channels, with legal frameworks that both sides trust. When China tries to replace that business with increased trade to, say, Ethiopia or Indonesia, the economics change dramatically. Payment risk increases. Currency volatility becomes a major headache. Legal protections weaken. And most importantly, the ability of these markets to absorb the same volume of high-value goods simply doesn't exist yet. Consider this stark reality. India, one of China's largest BRICS partners, ran a trade deficit with Beijing of $99.21 billion in the fiscal year. Ending March 2025, that's not a partnership. That's dependency, and India knows it. At the 2025 BRICS summit, India's external affairs minister openly called for addressing these trade imbalances, essentially admitting that BRICS trade isn't working for everyone equally. Russia, another major BRICS member, contributed $68.7 billion in bilateral trade with India. But most of that was oil sales, driven by desperation after Western sanctions, not sustainable economic partnership. So, let's address the elephant in the room. Can BRICS actually create a trading system that rivals or replaces the Western-dominated order? The answer is complicated, and it's unfolding in real time through three parallel tracks: currency, infrastructure, and political will. And China is pushing hard on all three fronts simultaneously. Start with currency, because this is where the most dramatic changes are happening beneath the surface. For decades, the US dollar has been the undisputed king of international trade. Between 58 and 60% of global foreign exchange reserves are held in dollars. 89% of currency exchanges involve the dollar on one side of the transaction. And the vast majority of global trade, including most oil transactions, gets invoiced in greenbacks. This isn't just convenient, it's the foundation of American economic power. When countries need dollars to trade, they need to keep America happy. When transactions flow through dollar-dominated banking systems, American sanctions have teeth. And when central banks hold dollar reserves, American monetary policy ripples across the entire world. BRICS wants to change that calculation, and they're making progress that's both more modest and more significant than the headlines suggest. As of early 2025, 67% of intra-BRICS trade is now conducted in local currencies rather than dollars. That's up from less than 50% just 2 years ago. Brazil and China have signed a yuan real trade settlement agreement. India is buying Russian oil in rupees, and projections indicate that almost half of all BRICS trade will soon be conducted in local currencies, particularly the Chinese yuan and Indian rupee. But here's the critical detail that often gets lost in the excitement about de-dollarization. Intra-BRICS trade, meaning commerce between BRICS members themselves, represents only a fraction of total global trade. Trade in goods and services totaled about $33 trillion globally in 2024. Even if BRICS completely eliminated the dollar from their mutual trade, they would only be circumventing dollar usage in a relatively small slice of cross-border transactions. The lion's share of international finance, including foreign exchange markets worth $7.5 trillion per day, still runs overwhelmingly in major Western currencies. China has built the infrastructure to support this transition. The cross-border interbank payment system, known as CIPS, now connects 4,800 banks across 185 countries, allowing trade to be conducted in yuan without touching the dollar-dominated SWIFT network. As of January 2025, CIPS had 1,467 indirect participants across 119 countries. That's real infrastructure representing real alternatives to Western financial plumbing. But infrastructure alone doesn't create trust, and trust is ultimately what reserve currencies are built on. The dollar didn't become the world's reserve currency because America forced it to happen. It became dominant because people trusted it more than the alternatives. They trusted American institutions, American legal systems, American economic stability, an American commitment to allowing that currency to be used globally, even when it wasn't always in America, as immediate interest. Does anyone have that same level of trust in the yuan, in the rupee, in any BRICS currency? The honest answer, backed by actual reserve holdings and trading patterns, is no, not yet, threatening 100% tariffs on any BRICS nation pursuing de-dollarization or launching alternative currencies. Some dismissed this as typical Trumpian bluster. Others saw it as recognition that the dollar's supremacy is more fragile than Washington likes to admit. Either way, the threat revealed something important. The transition away from dollar dependence, if it happens at all, will be contested, costly, and potentially dangerous. Now let's talk about what's actually happening inside China's economy, because this is where the BRICS question becomes existential. Chinese exports reached a record peak of $357.8 billion in December 2025, surging 6.6% and smashing expectations. For the full year, exports rose 5.5% to $3.77 trillion. On the surface, this looks like validation of China's strategy. Who needs Western markets when you can sell everywhere else? But dig deeper into the data, and a more troubling picture emerges. China's trade surplus for 2025 is projected to exceed $1.2 trillion, breaking all previous records. That's not a sign of strength. That's a red flag waving over an economy that's producing far more than its own people can consume. Final consumption expenditure in China contributed 53.5% to economic growth in the first 3 quarters of 2025, up from 44.5% the previous year. That sounds positive until you realize it's still nowhere near the consumption-driven model that characterizes healthy, developed economies. Here's the uncomfortable truth that Chinese policymakers are wrestling with. Domestic demand is weak and getting weaker. Real estate, which accounts for more than 15% of the Chinese economy and has extensive linkages to everything from furniture to home appliances, has been in freefall since 2021. Sales and investment in the property sector have been cut by half from their peaks. Meanwhile, local government finances are strained by off-budget debts, forcing cuts in spending that put further downward pressure on domestic demand. Chinese households, watching property values decline and feeling uncertain about future income, are saving at unprecedented rates. Household deposits increased by 15 trillion yuan in 2023, 18 trillion yuan in 2024, and another 10 trillion yuan in just the first half of 2025. When your own people won't spend money, you have 2 choices. Either fix the underlying problems driving that caution, or find external markets to absorb your excess production. China is trying to do both, but the external market strategy is running into hard limits. Because here's what the trade data really shows. China isn't successfully replacing Western markets with BRICS alternatives. It's simultaneously losing U.S. market share while desperately clinging to European markets and expanding into developing markets that can't fully compensate for American losses. Look at what actually happened in 2025. Chinese exports to the United States didn't just decline, they collapsed. Down 25% in October, down 28% in November, down 30% in December, and down 20% for the full year. Even after the US and China agreed to scale back some tariffs, American consumers and businesses were actively shifting away from Chinese suppliers. But exports to the European Union climbed, up 7% for the first 7 months, up over 10% in the second half, reaching a total of $850 billion in annual trade. Germany, the Netherlands, and France are all increasing their purchases of Chinese industrial equipment, electric vehicles, and green technology. This creates a fascinating dynamic. Europe is becoming China's economic lifeline, even as European policymakers talk about de-risking and reducing dependence on Chinese supply chains. The EU sees China simultaneously as a partner for cooperation, an economic competitor, and a systemic rival. Yet trade keeps growing because European industries need Chinese components, European consumers want Chinese products, and European companies can't easily replicate Chinese manufacturing efficiency and scale. Meanwhile, China's exports to Africa surged 22%, to ASEAN 22.5%, to Latin America nearly 10% in the latter part of 2025. These are impressive numbers that demonstrate real market diversification, but they're coming from a much smaller base than European or American trade, and they're happening in markets with fundamentally different characteristics. When European companies buy Chinese products, they're often incorporating them into higher value supply chains, paying in euros through established banking channels. When African buyers purchase Chinese goods, transactions often involve more complex financing arrangements, higher risk premiums, and lower absolute values per transaction. Here's a question worth considering. If BRICS markets were truly comparable substitutes for Western markets, why is China working so hard to maintain and grow its European trade, even while expanding BRICS commerce? The answer is that Chinese economic planners understand what the raw trade numbers sometimes obscure. Not all export dollars are created equal. A dollar earned from selling semiconductors to Germany is worth more in real economic terms than a dollar earned from selling textiles to Nigeria, even though both show up identically in trade statistics. This brings us to the political dimension of BRICS, which is simultaneously its greatest strength and most fundamental weakness. The bloc's diversity is its selling point. Democracies like Brazil and India sitting alongside authoritarian states like China and Russia. Oil exporters partnering with oil importers. Countries at wildly different stages of economic development, united by shared frustration with Western-dominated institutions. But diversity also means divergent interests, and those differences are becoming impossible to ignore. India wants to use BRICS as a platform to increase its global influence while maintaining strong ties with the United States and Europe. Its leaders explicitly state they're not interested in replacing the dollar or joining an anti-Western coalition. Russia needs BRICS as an economic lifeline after being cut off from Western markets by sanctions. Its motivation is survival, not revolution. Brazil sees BRICS as a way to amplify the voice of the global South in international affairs, but has no interest in sacrificing its relationship with the United States for an uncertain partnership with Beijing. The United Arab Emirates joined BRICS to diversify its diplomatic and economic relationships while maintaining its role as a crucial financial bridge between East and West. These aren't trivial differences. They're fundamental contradictions that make unified action extremely difficult. The response wasn't collective defiance. It was each country calculating its own interests and hedging its bets accordingly. Brazil pushed back strongly because sovereignty matters to its political identity. India emphasized it wasn't pursuing dollar replacement. China made statements about not succumbing to pressure, but quietly signaled flexibility in bilateral negotiations. These aren't the actions of a cohesive bloc ready to revolutionize global commerce. Consider what happened at the 2025 BRICS summit in Brazil. The meeting was supposed to showcase unity and announce dramatic steps toward financial independence. Instead, Putin and Xi didn't even attend in person, sending representatives instead. Talk of a common BRICS currency, which had dominated discussion at previous summits, was notably muted. The joint declaration mentioned initiatives like the BRICS payment system and emphasized expanding trade in local currencies, but there were no concrete deadlines, no binding commitments, and no mechanisms for enforcement. It was more aspiration than action plan. Illustrates both the promise and limitations of BRICS cooperation. The bank has increased lending in local currencies and funded projects without the policy conditions typically imposed by Western institutions. That's real progress toward financial sovereignty. But when Russia faced sanctions after invading Ukraine, the NDB stopped doing business with Russia entirely because other member states didn't want to risk losing access to dollar funding. So much for solidarity. This gets to the heart of why BRICS can't simply replace Western markets for China. Markets aren't just about finding buyers for your products. They're about stable legal frameworks, reliable payment systems, currency convertibility, intellectual property protection, and 1,000 other factors that make trade efficient and predictable. The Western-dominated system didn't emerge because Westerners are smarter or better. It emerged because over decades, often through painful trial and error, institutions were built that made cross-border commerce work reasonably well for most participants. BRICS is trying to build parallel institutions, and they're making real progress. But building institutions is hard. Building trust is harder. And building systems that can handle the complexity and scale of modern global commerce is the work of decades, not years. China has the manufacturing capacity to produce goods for the entire world. Political instability, infrastructure deficits, and the simple fact that developing economies don't consume at the same rate or in the same ways as developed ones. Here's what the data actually tells us when we strip away the hype and the fear. China's trade with BRICS is growing, and that growth is real and significant. Between 2017 and 2022, intra-BRICS trade increased 56%. The bloc's combined GDP surpassed that of the G7 in purchasing power parity terms. China's exports to belt and road countries, many of which overlap with BRICS partners, hit $3 trillion. These aren't imaginary achievements, but China's trade with the European Union in 2025 was $850 billion. Trade with the United States, even after the collapse, was still over $600 billion. Combined, those two destinations represent roughly $1.45 trillion in annual commerce, nearly half of China's total exports. And unlike trade with many BRICS partners, Western trade involves higher value products, more stable payments, and established business relationships built over decades. Can BRICS replace all of that? The evidence says no. Can BRICS provide enough diversification to reduce China's vulnerability to Western market disruptions? The evidence says maybe, but only partially. Is China better off with BRICS than without it? Absolutely. Does BRICS offer China strategic alternatives that didn't exist a decade ago? Without question. But replacement? Complete replacement? That's not what the numbers support. The future that is actually taking shape looks less like BRICS replacing Western markets, and more like the emergence of a genuinely multipolar trading system where China sells to everyone. In this scenario, which is already happening in real time, Chinese exports to the United States might stabilize at a lower level, while European demand continues growing modestly. BRICS markets expand, but from a smaller base, meaning their growth doesn't fully offset Western losses in absolute terms. And China increasingly customizes its export strategy for different markets, selling high-tech goods to developed economies and different product mixes to developing ones. The wild card in all of this is China's domestic market. If Beijing can actually solve the consumption problem, if Chinese households start spending instead of saving, if the property market stabilizes and local governments get their finances under control, then the whole equation changes. China wouldn't need to replace Western markets with BRICS alternatives because it could consume more of its own production. Domestic demand would drive growth instead of export surpluses. But that's a massive if. The structural problems driving weak consumption are deeply embedded in China's economic model, and fixing them requires politically difficult reforms that the leadership has been reluctant to fully embrace. Meanwhile, the push for BRICS financial independence continues with mixed results. The proportion of BRICS trade conducted in local currencies keeps rising. China's CEP system keeps expanding. The new development bank keeps lending. BRICS Pay and other alternative payment systems keep being discussed and piloted, but the dollar's dominance remains largely intact. As of, these aren't trivial differences. They're fundamental contradictions that make unified action extremely difficult. When Trump threatened tariffs on BRICS nations over de-dollarization efforts, the response wasn't collective defiance. It was each country calculating its own interests and hedging its bets accordingly. China made statements about not succumbing to pressure, but quietly signaled flexibility in bilateral negotiations. These aren't the actions of a cohesive bloc ready to revolutionize global commerce. The meeting was supposed to showcase unity and announce dramatic steps toward financial independence. Instead, Putin and Xi didn't even attend in person, sending representatives instead. Talk of a common BRICS currency, which had dominated discussion at previous summits, was notably muted. The joint declaration mentioned initiatives like the BRICS payment system and emphasized expanding trade in local currencies, but there were no concrete deadlines, no binding commitments, and no mechanisms for enforcement. It was more aspiration than action plan. The new development bank, created by BRICS in 2014 as an alternative to the World Bank and International Monetary Fund, illustrates both the promise and limitations of BRICS cooperation. The bank has increased lending in local currencies and funded projects without the policy conditions typically imposed by Western institutions. That's real progress toward financial sovereignty. But when Russia faced sanctions after invading Ukraine, the NDB stopped doing business with Russia entirely because other member states didn't want to risk losing access to dollar funding. So much for solidarity. This gets to the heart of why BRICS can't simply replace Western markets for China. Markets aren't just about finding buyers for your products. They're about stable legal frameworks, reliable payment systems, currency convertibility, intellectual property protection, and 1,000 other factors that make trade efficient and predictable. The Western-dominated system didn't emerge because Westerners are smarter or better. It emerged because over decades, often through painful trial and error, institutions were built that made cross-border commerce work reasonably well for most participants. BRICS is trying to build parallel institutions, and they're making real progress. But building institutions is hard. Building trust is harder. And building systems that can handle the complexity and scale of modern global commerce is the work of decades, not years. China has the manufacturing capacity to produce goods for the entire world. BRICS has the population and geographic spread to theoretically consume those goods. But the gap between theoretical potential and practical reality is filled with currency risk, political instability, infrastructure deficits, and the simple fact that developing economies don't consume at the same rate or in the same ways as developed ones. Here's what the data actually tells us when we strip away the hype and the fear. China's trade with BRICS is growing, and that growth is real and significant. Between 2017 and 2022, intra-BRICS trade increased 56%. The bloc's combined GDP surpassed that of the G7 in purchasing power parity terms. China's exports to belt and road countries, many of which overlap with BRICS partners, hit $3 trillion. These aren't imaginary achievements, but China's trade with the European Union in 2025 was $850 billion. Trade with the United States, even after the collapse, was still over $600 billion. Combined, those two destinations represent roughly $1.45 trillion in annual commerce, nearly half of China's total exports. And unlike trade with many BRICS partners, Western trade involves higher value products, more stable payments, and established business relationships built over decades. Can BRICS replace all of that? The evidence says no. Can BRICS provide enough diversification to reduce China's vulnerability to Western market disruptions? The evidence says maybe, but only partially. Is China better off with BRICS than without it? Absolutely. Does BRICS offer China strategic alternatives that didn't exist a decade ago? Without question. But replacement? Complete replacement? That's not what the numbers support. The future that is actually taking shape looks less like BRICS replacing Western markets and more like the emergence of a genuinely multipolar trading system where China sells to everyone. In this scenario, which is already happening in real time, Chinese exports to the United States might stabilize at a lower level, while European demand continues growing modestly. BRICS markets expand, but from a smaller base, meaning their growth doesn't fully offset Western losses in absolute terms. And China increasingly customizes its export strategy for different markets, selling high-tech goods to developed economies and different product mixes to developing ones. The wild card in all of this is China's domestic market. If Beijing can actually solve the consumption problem, if Chinese households start spending instead of saving, if the property market stabilizes and local governments get their finances under control, then the whole equation changes. China wouldn't need to replace Western markets with BRICS alternatives because it could consume more of its own production. Domestic demand would drive growth instead of export surpluses. But that's a massive if. The structural problems driving weak consumption are deeply embedded in China's economic model, and fixing them requires politically difficult reforms that the leadership has been reluctant to fully embrace. In November 2025, the dollar is still used in 89% of currency exchanges and comprises 56% of global reserves. The yuan's share of global reserves is less than 5% despite all the progress. Think of it this way. The BRICS project isn't about suddenly overthrowing the existing order. It's about gradually building alternatives that make the system more multipolar and less vulnerable to unilateral American or European action. For China specifically, it's about ensuring that if Western markets become less accessible through tariffs, sanctions, or political tensions, there are other options available. Those options won't be perfect substitutes. They won't offer the same value, stability, or scale, but they'll exist, and their mere existence changes the strategic calculation. So can BRICS really replace Western markets for China? No. Can BRICS reduce China? Is dependence on Western markets enough to give Beijing more freedom of action and reduce economic vulnerability? Yes, but only to a degree. The real answer is that BRICS provides China with valuable diversification and bargaining leverage, but it cannot and will not fully substitute for the economic relationship China has built with the developed world over 4 decades. What we're witnessing isn't a clean break or dramatic revolution. It's a messy, complicated, uneven process of economic rebalancing, driven partly by Chinese strategy and partly by Western policies that are pushing China to find alternatives. The outcome won't be BRICS replacing Western markets. It will be a more fragmented global trading system where China operates in multiple parallel markets, each with different rules, different currencies, and different strategic implications. For China, this means lower growth potential than a world where Western markets remained fully open. For the West, it means reduced leverage over Chinese behavior and less economic integration with the world's largest trading nation. For BRICS countries, it means opportunities to trade more with China, but also risks of becoming economically dependent on Beijing, without gaining the benefits that come from balanced trade relationships. The numbers from 2025 make this clear. China exported $3.77 trillion worth of goods while posting a trade surplus of over $1.2 trillion. It grew trade with BRICS while simultaneously clinging to European markets and getting devastated in America. It launched alternative payment systems while watching the dollar maintain dominance. It built institutions designed to reduce Western power while remaining deeply embedded in systems those same Western powers created. This is the actual story of BRICS and China. Not replacement, but diversification. Not revolution, but evolution. Not the end of Western economic dominance, but its gradual and contested diminishment. The question isn't whether BRICS will fully replace Western markets, because it won't. The question is how much influence and prosperity China can build in this new multipolar reality, and whether that's enough to sustain the growth model that has lifted hundreds of millions of Chinese citizens out of poverty over the past 40 years. The answer to that question is still being written in the trade data that gets released every month, in the currency swap agreements being negotiated behind closed doors, in the infrastructure being built across Asia and Africa, and in the decisions being made by businesses and governments around the world about where to source products, where to invest capital, and which economic partnerships to prioritize. Let's get specific about what this means in practical terms. When a Chinese electric vehicle manufacturer looks at its export strategy today, it's making fundamentally different calculations than 5 years ago. The American market, once the ultimate prize, is now off limits due to tariffs and political hostility. But that manufacturer can look at Indonesia, Brazil, or the United Arab Emirates. These aren't perfect substitutes for California's wealthy consumers, but they're real markets with real demand, and collectively they add up to significant volume. This shift is being actively facilitated by Chinese government policy. The Belt and Road Initiative has engaged over 140 countries. Trade with Belt and Road partners reached $3.02 trillion in the first 11 months of 2025, up 6%. These are coordinated efforts to build infrastructure and create demand in previously disconnected markets. Chinese policy banks have extended hundreds of billions in credit to fund projects in BRICS and Belt and Road countries. Some of this financing has been controversial, with accusations of debt-trap diplomacy and unsustainable lending. But the strategic logic is clear. By financing the construction of ports, railways, power plants, and telecommunications networks, China is literally building the infrastructure necessary for these countries to become more effective trading partners. A port built with Chinese loans by Chinese companies using Chinese equipment naturally becomes a node in Chinese-oriented supply chains. The technology dimension of this strategy deserves particular attention, because it reveals how China is trying to create dependency relationships that mirror what the West achieved in previous decades. When Chinese companies like Huawei build telecommunications networks across Africa and Asia, when Chinese payment systems penetrate new markets, when Chinese digital platforms gain users in developing countries, consider the digital yuan, China's central bank digital currency. While Western central banks are still debating whether to launch their own digital currencies, if BRICS countries and Belt and Road partners adopt systems compatible with the digital yuan, it creates a parallel financial infrastructure that operates independently of dollar-based banking. This isn't just about facilitating trade, it's about building monetary sovereignty. Building alternative systems requires partners who are willing and able to participate. And when you look at actual behavior rather than aspirational declarations, the picture becomes more complicated. New Delhi's proposal to link BRICS central bank digital currencies is less about empowering yuan alternatives and more about ensuring that any new system does not simply substitute Chinese control for American control. Russia, despite its current alignment with China driven by Western sanctions, or the United States, which, despite everything, remains crucial to Brazilian agricultural exports and investment flows. These political uncertainties matter because they create instability in exactly the areas where successful trade relationships require stability. A European company making a 10-year investment decision in China knows that despite political tensions, there are institutional mechanisms, legal frameworks, and economic interests that make complete breakdown unlikely. Can the same be said for relationships within BRICS? When the next political crisis erupts, when domestic politics in India or Brazil shift, when geopolitical pressures intensify, will BRICS economic cooperation survive intact? The track record so far suggests caution is warranted. Let's talk about the commodity dimension, because this is where BRICS has genuine structural advantages that could prove durable. The bloc controls enormous natural resource wealth. Russia's energy reserves, Brazil's agricultural production, South Africa's minerals, the UAE's oil, not to mention China's own rare earth monopoly. When you need oil, copper, or soybeans, you buy from whoever has them at competitive prices. Political considerations matter less when you're filling strategic reserves or feeding your population. This is why commodity-focused initiatives like the proposed BRICS Precious Metals Exchange are potentially significant. If BRICS countries can create trading platforms for gold, platinum, rare earth minerals, and other commodities that operate in local currencies rather than dollars, they're leveraging real supply-side power. The West needs these materials. China needs these materials. Everyone needs these materials. Controlling the terms on which they are bought and sold creates genuine leverage. But even here, market realities impose constraints. Commodity trading requires price transparency, contract enforcement, and dispute resolution mechanisms that buyers and sellers trust. The London Metal Exchange and Chicago Mercantile Exchange didn't become dominant because of Western imperialism. They became dominant because they created systems that worked reliably for all parties. Creating alternatives that are genuinely better, or even comparably trustworthy, is a massive undertaking that requires more than just announcements at summit meetings. Think about what it actually takes to create a successful alternative trading system. You need standardized contracts that everyone understands and accepts. You need clearinghouses that can manage counterparty risk. You need price discovery mechanisms that people trust, reflect genuine supply and demand rather than manipulation. You need deep liquidity so that participants can enter and exit positions without moving markets. You need regulatory oversight that prevents fraud without stifling legitimate activity. Building all of this from scratch while competing with established systems that have decades of refinement is incredibly difficult. The BRICS nations are attempting this ambitious project at the same time they are dealing with massive domestic challenges. China's property crisis and wheat consumption, India's infrastructure deficits and poverty challenges, Russia's war-driven economic distortions, Brazil's fiscal problems and political polarization, South Africa's electricity crisis and unemployment. These aren't minor issues. There are fundamental constraints on each country's ability to play the role that BRICS coordination requires. You can't build alternative global financial architecture when you're simultaneously trying to prevent economic crisis at home. And yet, despite all these challenges and limitations, something undeniably real is happening. Trade patterns are shifting. Alternative payment systems are being built. New institutions are being established. The BRICS project, however imperfect and incomplete, is creating options that didn't exist before. For China, that alone makes it worthwhile, even if those options never fully replace Western markets. Consider the strategic value from Beijing's perspective. Every percentage point of trade that shifts to BRICS markets is a percentage point less vulnerable to American tariffs or European anti-dumping measures. Every yuan-denominated transaction is one less point of dollar leverage over Chinese economic policy. Every infrastructure project in Africa or Asia is a potential future market or supply chain node. Even if BRICS only partially succeeds, even if it only captures 20 or 30% of what China loses in Western markets, that's still valuable strategic diversification. This is why predictions of imminent dollar collapse or Western economic irrelevance are premature at best. But it's also why dismissing BRICS as irrelevant or doomed to failure misses what's actually happening. The global economic system is becoming more pluralistic, more fragmented, more complex. China is building position in this emerging order, using BRICS as one tool among many to ensure it has alternatives when Western markets prove unreliable or hostile. The implications extend far beyond trade statistics. We're watching the architecture of global commerce evolve in real time, the post-World War II system built around dollar dominance, Western institutions, and American economic leadership is not collapsing. But it is being supplemented by alternative arrangements that reduce its monopoly power. Whether this leads to a more stable, multipolar system or increasing fragmentation that reduces global efficiency remains to be seen. What we can say with confidence is that China's economic future won't be determined primarily by BRICS. It will be determined by whether Beijing can solve its domestic consumption problem, whether Chinese companies can continue moving up the value chain in manufacturing and services, whether the political system can adapt to slower growth and changing demographics, and whether China can maintain productive relationships with both Western and non-Western economies simultaneously. BRICS is part of that equation, but only part. The idea that Brazil, India, and Russia can replace America and Europe as markets for Chinese goods overestimates BRICS' capacity, while underestimating the embedded advantages that Western markets continue to offer. So we return to where we started. The numbers from Beijing tell a story of adaptation, not replacement, of diversification, not revolution, of incremental progress toward alternatives, not sudden transformation of global commerce. China sold $3.77 trillion of goods in 2025 to markets all around the world. But Europe and America together still accounted for roughly 40% of Chinese exports despite all the tensions. BRICS provides China with options, leverage, and insurance against worst-case scenarios, but it doesn't provide full replacement of Western markets. The global economy is too complex to simply recreate what already exists. And slowly adjusting to a reality where China matters more, where emerging economies have more voice, but it's not replacement. It's evolution, and evolution is never as clean or complete as revolution.